A very Wellington scene, as you could imagine. Somebody being buffeted by the wind, and that is the kind of theme of what we're sort of really talking about here right now with respect to the economy. So we've been in a situation where the economy has been gradually recovering overall. It's very patchy recovery. There's bits of the economy that are doing a bit better than others. Certainly not broad-based growth right now. But it was all looking quite encouraging. Combination of lower interest rates and a stronger terms of trade, stronger export prices really starting to help kick things on a bit. But now we have the chill wind of Donald Trump and his administration flowing through the economy, buffeting us, and basically meaning that we need to roll with those punches to see how things are going to evolve from here. So the theme of this time's outlook is firstly kind of what's a baseline view about how this is all going to pan out. But then let's think about some of those risks as well, because there are many of them. And any economist who's been standing up in front of you in the last 2 months, 3 months has used the term uncertainty many times. I believe in the Reserve Bank monetary policy statement yesterday, the term uncertainty was used 150 odd times or something like that. So, which is a nice way of saying I don't know. So this is what we're thinking in terms of growth, right? And basically in the baseline, we think we're still looking at a picture where the economy is going to continue to recover as we go through the year. We had some better news about how the economy ended last year, in that we got 0.7% growth in the fourth quarter, and that was a bit more than we really thought was going to be the case back then. And we think that the economy will continue to build on that momentum. Certainly probably isn't going to be that strong as 0.7 a quarter for the first half of this year, which we've just about finished now. But as we're getting through into the second half of the year, we certainly think we'll be getting to those sort of levels. And as a result, for the year overall, we've got GDP growth at about 2.7%, 2.8% the year after that. That's a little bit above trend growth that we think now. So I know that it's a bit disappointing to kind of be told that your growth forecast is only going to be sort of like somewhere in the high to mid twos. But unfortunately, given the level of productivity growth that we see here now, that's kind of about all this economy seems to be able to deliver right now. And we certainly don't have anything in our forecast that's really going to shift that underlying potential for the time being. So picture there expectations of a general recovery in the economy. This spaghetti chart I like to show customers tries to give us a feel for sort of like the highest frequency indicators of where the economy's tracking to see sort of like where things are. The thing I'll point you to is the kind of pink kind of shaded area in the middle here, which basically shows that the economy was obviously at its weakest point back in July last year and has generally been improving even in the last few months or so. I will say though, in the last couple of months, you can see there's a couple of indicators starting to point downwards a little bit, as well as quite a few pointing upwards. Basically, we've got improved business and consumer confidence. The PMI's looking a little bit better as well, which is suggesting the manufacturing sector in particular is doing a bit better. The laggards, and the other thing I'll say is the housing market is probably doing okay as well. I mean, we've had 6 consecutive rises in house prices. Days to sell is down to about 44 days, which is all very consistent with a recovering housing market. The laggards here is really in the areas of the labour market where we're not really seeing an increase in hiring out there at the moment. There's not really a huge amount of firing either. But certainly it is the case that it's taking a while for the labour market to really start to turn. To be honest, we kind of expected that all along because we think that's really a second half of this year story as opposed to something we're thinking about right now. And the really positive indicator here is business confidence, where if we look at what businesses are saying, they're very optimistic about the future. They're actually not that happy about what's going on now, and there's quite a big gap between those two perceptions, which I think helps kind of square the circle between someone like me standing up in front of you and saying, well, I think this economy is going to recover, and the reality on the ground right now, where particularly if you're in the urban areas, it doesn't really feel like it. So let me get into the first poll question of the day. By the end of this year, how many employees do you expect to have? You think you're going to have less? You're going to have about the same? Are you just going to have the same but make them work a bit harder? Do a bit more overtime? Or are you going to be expanding your workforce? Let me know. Very good. So about the same. Maybe a fewer. Oh no, it's a bit split really, sort of like around there. Certainly not a lot of extra hiring, kind of like in the thing in the view at the moment. I think that's probably a reasonable view. I mean, this is our forecast for what the labour market is going to do. And, you know, one thing that we've been pleasantly surprised by is that the unemployment rate is not probably rising as quickly as we might have thought it would 6 months ago. There was actually no rise in the unemployment rate in the first quarter. 5.1% is where it stayed at. We still think that it's going to rise a bit further. We think it's going to get up to 5.3% and then sit there for a little while and then gradually tail off as we go through the second half of the year. It's that story I told you before that there's not much hiring going on. There's also not much firing. Population growth is continuing, so therefore growth in the labour force is just going a little bit faster than growth of the flow of new jobs, and as a result that unemployment rate is just drifting up a bit. We would expect, you know, if you look at those pink bars, you know, we're going to probably see some employment growth in the last quarter of this year. It's probably when you should really start to see that. And we're obviously alert for any signs that we don't see, that we actually see negative employment growth, because that would suggest that that part of the economy is going backwards. But right now, that view hasn't really shifted very much. As I said, we've revised down the unemployment rate profile a bit, and it's just going to be a bit longer before I think we see tangible signs of a stronger labour market. In terms of the housing market, everybody's very interested in that in New Zealand. We're basically a dairy farm with a housing market attached to it, or maybe it's a housing market with a dairy farm attached to it, I'm not sure. Still got a constructive view on house prices. The housing market, as I said, has been gradually improving. We've revised down our forecast for the whole year by a little bit. I think it's moved down from about 7 to about 6. But things are moving in the correct direction. Houses are selling a bit faster, particularly if you're outside of some of the major urban centres. Like a lot of the areas down in the South Island, for example, have much stronger housing markets than you see, for example, in Auckland and particularly Wellington, which remains the epicentre of negativity in the economy. You know, for example, Southland house prices are actually above the peaks that they reached through the COVID period, where things went a bit crazy with house prices. So that's quite remarkable. And we think that will just continue as we go through the year. And really the big driver there is the fall in interest rates that's occurring. It would be stronger, I think, if the labour market was going to be stronger, but we don't really have that expectation for now. So hence we've got what I would consider to be a relatively muted return to average type view for what house prices are going to do. The government is obviously very topical right now. We just had the budget last week. Interesting budget. You know, so the minister talked a lot about bending the curve, you know, basically trying to slow the rate at which debt is accumulated in the public sector and the government. And I think she achieved that. She had to really go with some cuts to be able to make sure that that would occur, because what has happened to the government is that their revenue forecasts have come down because the economy has been weaker than they thought, and they're forecasting that it'll remain relatively weak because of what Donald Trump is doing to the global economy. So all else equal, that would have led to forecasts of larger deficits for longer, and so they offset those through a combination of cuts to operational spending that they're anticipating would occur for the foreseeable future. They're basically saying that this government and the next two governments are going to have very tight fiscal policy for, you know, the next 5 or 6 years. It'd be interesting to see if that happens. And they also they made some other changes. For example, that pay equity law change has significantly reduced their expectations for wages costs in the public sector. So after all of that, it all came out at a bit of a wash in the sense that we still have a sliver of a surplus in 2028, 2029. You have to stare very hard at this chart to see that sliver. To be honest with you, and if you look at the old Obergell measure, which basically includes the cost of ACC, you'll see there's no surplus there at all until the 2030s. So that just illustrates that we're still in quite a tough fiscal situation. Our forecasts are a little bit more optimistic than that because we see better revenue growth in the economy because we think commodity prices in the terms of trade will be stronger. But none of these lines are particularly suggesting that we're going to be seeing a surplus anytime soon. But the curve is bending. It bends particularly more in our forecast because these lines assume that the government is going to save most of that extra revenue that they get from higher commodity prices over the next few years. Be interesting to see if that happens too. We're going to have another think about that as we go through into our next review in August. But certainly from the government's perspective, you can see here the bending of the curve where debt to GDP has been rising quite rapidly, and in the forecast horizon it rises a little bit more and then flattens off and eventually starts to tail down at the end of the forecast period. The really interesting kind of thing, of course, going on right now is what's going on with the world. That's the real big driver of uncertainty right now. So this shows our forecasts for what we think is going to happen to global trading partner growth. And it has been revised down a reasonable amount. Perhaps not as much as other commentators have done. For example, my ex-colleagues at the fund made bigger downward adjustments to global growth than this. Similarly, so did the Reserve Bank and the Reserve Bank of Australia in the last couple of weeks. And the difference there is that if you look at what we've done, the implications of the tariff policies are particularly hitting the US outlook. So if you compare, for example, the 2024 red bars for each country to the lighter coloured bar right next to it, you can see that US growth is expected to be sharply weaker over the next couple of years than it has been. There's less impact in our forecast coming from China. So you can see there that Chinese growth forecast is still solid as a rock at 5% for this year and slightly lower for next year. And that is a view that our colleagues in Australia have taken, and indeed I think the RBA shares this view, that the Chinese authorities have a lot of tools at their disposal to try to stave off weakness in GDP growth, whether that be through monetary easing or fiscal easing. And if they do that successfully, that's going to be actually quite good news for countries like New Zealand and Australia because they're our biggest trading partner and they're really important for the economic outlook in East Asia as well, because those are all of our sort of larger like trading partners there. It's quite important for Australia. Australia is quite important to us because they're our third biggest trading partner. So there is a relatively optimistic view there that as long as the Chinese do what they say they're going to do, that New Zealand will have a degree of insulation from this global shock. And I guess the question you have to ask yourself, though, is what if that's too optimistic? And we do ask that question a little bit later in the presentation. But contingent on that view, where global growth is maybe down by, say, 0.4% or so, or 0.5% relative to what we might have thought sort of late last year, early this year, well, the implications are that we're going to keep a lot of the gains in commodity prices that we've been able to receive over the course of the last year. So we've seen broad-based strength in a lot of the commodity prices out there, whether it be the dairy sector. I saw the Fonterra out this morning telling us they thought that the payout estimate for next year would be $10, which is what we forecasted they would say back in February. $10 is an awesome payout in nominal terms for that sector. But also even the sheep and the beef guys, the horticultural guys, they've all got very strong prices right now and also quite a bit of product that they're being able to sell. And that's really kind of having a positive impact on the economy, which we think will persist to some extent over the course of the next year. So we got about 15% increase in our terms of trade last year, which is one of the better years that you'd have seen in a very long time. And we think we'll probably keep that and basically put on another 8% over this year, all going well, consistent with that underlying view we've got there that, yes, there is a bit of a hit to global growth, but it's not necessarily going to be dramatic. The improvement in the commodity price outlook and the fact that it's maintained is also having an effect of improving our current account deficit. So the red line there, which got to quite scary high levels, we had over an 8% current account deficit there for a while, a couple of years ago. We think that's heading back to somewhere closer to sort of 3.5 now. And that's just the benefits of the terms of trade that's in there. It would be even better if the global economy was expected to perform more strongly, but it isn't. And as I said before, drivers of price gains, there's your milk price. 10.30 is what we think they'll end up with this year. We're right on the edge of Fonterra's range there at the moment, so we're still in the hunt. Hopefully it'll be 10.30, maybe it'll be 10.20. I won't beat myself up over 10 cents. There'll still be a few tractors bought. And next year, $10 as well, even in inflation-adjusted terms. These are pretty good returns for the dairy sector. And in the meat sector as well, about a year ago I was getting rung up all the time asking me to give comments on stories of woe in the sheep and beef sector and how bad it hadn't been since the mid-1980s. No one's asking me those stories anymore. What they're asking is, do I know anybody that's got any sheep or beef to send to the works because there's demand and there's no supply? And all of this is having the sorts of effects you might reasonably expect if you look at the regional distribution of activity in the economy, where the bits of the economy that are more leveraged to the primary sector and to some extent through the tourism sector are the ones that are spending much more strongly. As I said before, they have stronger house prices. They're generally stronger in most aspects of the economic data we look at. And obviously the urban areas are at the opposite end of the scale because they don't get those gains, at least not immediately. And it's probably reasonable to say there that Wellington is the weakest area of the country overall. Another interesting thing we've noticed in this is that if we look at the agricultural sector's cash flow position, it's improved quite markedly in the last year. What has tended to happen is as the farmers have got this extra money and they've been paying back debt, so credit growth in that segment of our portfolio is not very strong, which is not great news. But the better news is that they're building up some cash deposits. So then the kind of question then becomes, well, what's going to happen to that cash? So you can sort of see here that this is what tends to happen when commodity prices are stronger, is that people start to build up a bit of cash and eventually they spend it. Which brings me to my second poll question. So one of the curveballs that were in this budget, which was generally advertised as a bit of a tight budget, prudent budget, is that the government introduced accelerated depreciation on quite a broad range of investment. So what that basically means is you get a discount on your tax for anything that you kind of like buy in the first year you buy it. And the question I have of you is, well, what impact is that going to have? Do you think it'll have a pretty limited impact because you're not really thinking about doing any investment in the next year or so? Do you think you might pull the trigger a bit faster on stuff that you're already thinking about? Or do you reckon you might actually accelerate your investment plans because there's some additional benefits that can be had by investing a bit more now compared to what you were thinking before the budget? So there we are. The Auckland crowd says limited appetite right now. And I think that's probably a reasonable question to get from, say, this crowd. I'm going to ask a similar crowd in Hamilton what they think about this next time to see kind of what the differences is. Because, of course, you're only going to make investments if you think you've got a bit of cash flow coming through to make it worthwhile. Certainly the Treasury, they have some positive impact from this investment boost sitting in the forecast, but it's not very large really. But it is subject to quite considerable uncertainty. My sense is actually that this will actually have a bit of an impact, particularly in the primary sector, or those sectors that are actually just really starting to turn the corner, because it will actually improve the after-tax returns of the investment projects they are. But, we'll just have to see about that. Investment intentions in the economy, according to the surveys, are pretty strong, so maybe there'll be a big impact, or maybe not, because perhaps people are thinking Donald Trump is going to blow up the economy and perhaps it's time to pull back for a while. So the second big driver of what's going on with this recovery is what's happening with interest rates. And this chart here tries to give you a sense of the relative magnitude of the infusion of cash into the mortgage households compared to other cycles. Now we're up to 225 points of OCR cuts now, and mortgage rates are over 200 points lower. Westpac has a market-leading 3-year mortgage rate available right now, 4.95%. I'm not allowed to recommend it, but the Reserve Bank Assistant Governor yesterday recommended that people go longer on their mortgage, which was an interesting comment. But getting back to the numbers, it basically implies that some of these mortgage households might be getting an additional 4% of disposable income more than they were getting with those higher interest rates a while ago. And that's once the current rates fully flow through. They just started to flow through in Q1. The Reserve Bank issued some data to show that interest paid by households had just fallen a smidge in the first quarter, so everybody's just slowly going off those higher fixed rates. But there's a real torrent of these things going on right now, and certainly inside this bank there's a whole operational areas that are flat out repricing everyone's mortgage. So it'll be interesting to see where that money goes. And the thing I'll point out here is that this is one of the bigger infusions you've seen in easing cycles for quite a few years. And as a result, when the Reserve Bank says there are lags to monetary policy, it won't happen overnight, but it will happen. I think that's what they mean. So that raises a question I have of you is, where do you reckon the 2-year mortgage rate's going to be in a year? A few options up there, ranging from lower to perhaps even higher. What do you think? 4.5%, a little bit lower than current levels, or maybe around current levels? I reckon around current levels is not a bad bet myself. Anything under 5% I think is a pretty reasonable level. But you could get down to 4.5%, particularly if the Reserve Bank cuts a bit more, or if there's a bit more competition. And I'd probably say either of those options are probably broadly consistent with that analysis I showed you there in terms of the infusion disposable income. Nobody's expecting a hike, obviously. Interesting. So that's the baseline forecast. It's reasonably optimistic. It basically says that the recovery will continue. It's not going to be very special. It'll get us a bit above trend. Things will gradually return to more normal levels of slack in the economy and the labour market. But there's a ton of uncertainty around that issue. And, the next couple of slides are going to take you through how we thought about modelling that. And, the uncertainty is obviously coming from the trade environment and the daily changes in policies that are going on in the world. Indeed, just half an hour ago when I was sitting at my desk, the courts in the US had just apparently obviated Trump's tariff policies. So now he has to go to the appeals court and the Supreme Court ultimately to see if that's going to roll. And there's obviously been a whole range of announcements and counter-announcements in the last 3 months, ranging from tariffs on Chinese stuff of up to 145% now to sort of something closer to 40%. So, you're probably quite reasonable in saying you don't really know where that's going to end up. So what does this mean if we end up with a relatively bad scenario? And the scenario we had in mind is, okay, well, we're not going to say Armageddon here. There's no point doing scenarios about Armageddon because that's just going to tell you that everything's going to be bad. You know that. But what if, we get another 0.5% off global growth because things actually take a long time to kind of work their way through. We get a lot of uncertainty, persists for a while. Basically, something where the economy, instead of going onto this recovery track as we go through the back half of this year, just stalls because consumers decide not to spend any money, businesses decide not to invest anything, too risky, too uncertain. Obviously, we get lower terms of trade because people don't want to buy our stuff because they're not feeling as rich. Slower growth in, say, China, for example, is a key part of that story, where instead of having Chinese growth hold up at 5, it's sort of perhaps something closer to 4, 4.5. What does that mean? And how we see that playing through is through weaker consumption and investment, weaker GDP, and in particular, a good way of modelling it is just to think about what it does to the unemployment rate. So instead of having the unemployment rate peak at about 5.3%, we'd say that peaks somewhere closer to 6. So they'd be noticeably higher. That's going to create quite a lot of disinflationary pressure. Lower wages, for example, lower consumer spending, potentially lower business spending as well, because if consumers aren't spending, then businesses won't be spending. And you can see here, if you compare our baseline inflation forecast, which is one where inflation hangs around in the top half of the 1 to 3% band through this year and then heads back to 2% subsequent years, the alternative scenario says that inflation heads back down to somewhere closer to 1.5%. And if inflation is to go down to 1.5%, then the Reserve Bank could probably be cutting rates. That's just how it works, because that's what their target is. It's not an Armageddon scenario. It's actually probably a little bit more negative than the alternative scenarios that the Reserve Bank presented us yesterday. They came out with some that said that, our baseline view is that there's 1, maybe 2 cuts to go, and their negative scenario said, well, maybe there's 3. But with lots of qualifications around that. That didn't sound too scary. Our one would probably suggest you probably get a little bit more than that if that's the way it rolls out. But that would not be a good news scenario, I think. Like I often say to people, be careful what you wish for. If you get a 4% mortgage rate, it's probably because something horrible has happened to you. So that then raises the question, well, what do you guys think? What do you think will the trade war do to inflation in New Zealand? Because it's pretty clear that if you're in the United States where the tariffs are being imposed, then inflation can go up there. But we're not going to be imposing tariffs on anyone. What do you think? There's a few options there, ranging from different sort of factors that might impact on inflation, cheaper imports because, perhaps the Chinese try to dump some stuff here that they can't sell anywhere else. You just get a slower economy that pushes inflation down. Doesn't have much effect is a reasonable kind of view to take as well. Always kind of like running through to the idea is, well, what happens if inflation heads back up again because the Reserve Bank cuts rates too far and we end up with a repeat of the COVID experience where we went to 0 interest rates and then we had to spend the next 3 years unwinding the mistake. Let me know what you think. Well, I'm sure the Reserve Bank will be very happy to hear that no one thinks they're going to ease too far. So what have we got there? We're sort of, the dominant impact is just that general impact on the slower economy, which is probably not a bad bet. And then what? The next best option is really just not much change really, which is also not an unreasonable perspective to take as well. It's interesting because if we look at our inflation outlook, it's got a bit of rough and smooth, I would say. And we saw the Reserve Bank channeling a bit of this yesterday when they gave us this hawkish interest rate cut. In the short term, we think that inflation's probably going to peak around 2.8% later this year. So for most of this year, the Reserve Bank's going to be looking at numbers that are really nudging the top end of their target range. And, when you've got an inflation forecast at 2.7 or 2.8, a decent gust of wind will move that to 3. Certainly a $10 increase in oil prices might, or a fall in the exchange rate. A 2% fall in the exchange rate will probably pretty much do that, and exchange rates can do 2% in 15 minutes in current conditions. But then after that, because the economy is in a relatively weak place, because the unemployment rate is above trend, we do have this expectation that the domestic components of inflation are eventually going to moderate and are going to fall back down such that we do get inflation closer to 2 eventually, contingent on our interest rate forecasts. So then the kind of question is that if you're in charge of the Reserve Bank and you're trying to work out what to do, well, how much weight do I put on the threatening near-term outlook, which you actually might know more about because we usually know most about what's going to happen quite soon, versus what might happen in a year's time, which, frankly, given the level of uncertainty out there, you must have very wide confidence bounds around. And, that is exactly the sort of challenge that the Reserve Bank is wrestling with. That's why they're sort of saying to us, well, we've done 225 points of easing, feels like it's time to slow down and see exactly how things are going to pan out. a real challenge that we have with inflation here is that whilst the private sector, the more interest-sensitive segments of the economy are showing all the classic signs of disinflation that you would expect after having policy being so tight for a while, there are decent chunks of the economy that are not displaying that behaviour. And, basically anything that's orientated towards the government, whether it be local or general government, or sectors that are dominated by decisions in those areas, are the ones that are holding inflation up. Because these are segments, I believe, that are just less competitive. They're segments that say, where they see, oh, look, there's a cost increase, so you're going to pay, is how they kind of think about it. Whereas in the private sector, usually there's a bit of a conversation about, I don't know if they're going to keep paying if we put the price up. And that is just holding our inflation rate up. And realistically, it's going to continue to hold it up for a while because, one of the central things that government is doing right now to try to consolidate the fiscal budget is to try to push increasing costs on to the rest of us, whether it be through increased bus fares, increased driver's licence fees. There's a whole plethora of these things that are kind of coming through that look set to continue because of that insensitivity of price increases to inflation. And unfortunately for the Reserve Bank, there's not much they can do about that. They've got an inflation target. They haven't got a CPI X things that are really hard to get down target. We've tried those sorts of things before in the 1990s, ended in tears. It just basically means that if you've got bits of the CPI that are holding things up, then this is the sort of thing that does risk household inflation expectations becoming elevated, and they are getting more elevated because people have noticed that inflation isn't around 2%, that it's heading back up to 3%. And it's the sort of thing that means you've got to lean a bit harder against it to make sure that inflation doesn't go up too far. So that then leads me to my interest rate forecasts, which we did make a tweak to yesterday in light of the Reserve Bank's policy statement. I've had the view for a while that interest rates would probably bottom out at, say, 3.25% or 3%. And we had thought that they would do that last interest rate cut in the July meeting. Because the last time we heard from the Reserve Bank, they sounded fairly dovish, sounded like they were pretty keen on getting rates at least down to 3% reasonably quickly. Well, I think yesterday's comments sort of tell you that maybe there's a few more questions about that. The MPC now says that they don't actually have a bias for what they're going to do for rates at the next meeting, which tells you that there's a debate to be had there. And they even had a debate about the rate cut they did yesterday because one of them voted against it, which is extraordinary, certainly not what I expected. What I expected to see in that statement was discussions of alternative options and dissension, but nobody actually putting their hand up and saying, no, I'm not going to vote for this. That means that if they were having that argument then, that in the absence of anything really bad happening in the next 6 weeks or so, I would have thought those arguments would still be quite strong for saying, let's just wait until August when we will have seen the next CPI, when we may have a better idea about what Donald Trump is up to, get a bit more data about how the economy is responding to the new global trade environment. And then after about a year or so, actually towards the back end of next year, we have a return of interest rates back towards the neutral level of 3.75%. And we've put that in now after the election that's going to occur in Q3 or early Q4 next year. Although those are very much in pencil, those timings, that could move around quite a bit based off what happens in the next 6 to 12 months. So with that, we'll move on to Imre, who's going to tell us a bit more about what markets are going to do.
Yeah, thanks, Kelly. A lot to take on board there. And as Chris said, yes, great time to be an analyst, but trying to predict what Mr. Trump's going to do tomorrow is a fool's errand. That's the unpleasant side of the job. Still, we give it a crack, as we always do. And best guess for the next few months is that the Kiwi dollar goes up a little bit. Kiwi Aussie, two-toned, initially up, then down. Interest rates, short end, probably higher. Long end, about neutral. And therefore a yield curve slope a bit flatter than where it is now. So delving into each of those, Kiwi US first. How did we go last time? Always looking back. We thought an up and a down And that kind of panned out that way for just over halfway through the horizon. We thought, great. And then we got 2nd of April, Liberation Day, and the world's financial markets went into a panic. And unexpectedly, it actually hurt the US dollar more than the Kiwi dollar. So Kiwi US inexplicably rose a lot. So that up move, certainly not predicted. Looking ahead for the next quarter, just a gentle upward prediction. I'm thinking 61 probably tops it, and expecting a lot more ranging that we've seen over the last few months. Markets have been actually unusually volatile this year. You can put all of it down pretty much to volatility in the US dollar, in turn related to that new Trump administration. So really, it's all about the US dollar. And this, by the way, the US dollar is very much probably the hot topic in world's financial markets at the moment. Currency talk is really high on the agenda. Okay, just looking back at how the US dollar has played out, we had the run up to the US election and then the aftermath, and that was all positive for the US dollar. So the world's markets thought this is good for the US economy, and what they're doing will probably give rise to US exceptionalism in its economy, that we're going to outperform the rest of the world by a long way. So the money flocked into the US dollar. Then, after the inauguration, we started to see some policies rolling out, and the market went, this is going to hurt the US economy, so maybe not so exceptional. Then after the 2nd of April, we saw those severe and pretty bizarre tariff impositions, and the market went into a panic and said not only will it be unexceptional, but it could be exceptionally negative compared to the rest of the world. So they just sold the hell out of the US dollar. And since then, we've had a bit of backtracking from the administration, so the markets have calmed down a bit from the April panic. But I think we're in the sort of consolidation zone. And looking ahead, our best guess is that the US dollar has been tarnished. So the US dollar has this identity as the safe haven currency of the world, the number one reserve currency of the world. That's where you put your money when you want it to be kept safely. That identity has been tarnished. And our best guess is that's not going to go away in a hurry. Now, there's a debate, I suppose, as to whether it persists a year or two down the line. We don't know. But over the next few months, we'll say some of that scarring remains. And that really, I think, is the essence of our weaker US dollar and therefore slightly stronger Kiwi US to come. By way of a bit of evidence on the US dollar being tarnished, it's not just words and saying it and having some biases built in, but rather this is the evidence, one piece of evidence. Just look at correlations between the US dollar and risk sentiment, and you can take the US equity markets as a pretty good proxy for risk sentiment. Most of the time, the US dollar behaves inversely to risk sentiment. That is, when bad things happen in the world, risk sentiment goes down, the US dollar goes up. And that's because when markets are fearful, they put more money into the US dollar. When markets are less fearful and are risk-seeking, they do the opposite. They take the money out of the US dollar and they plough it into higher returning investments. So you see there's a fairly steady negative correlation there until about the last 9 months, when it kind of went close to oscillating around zero. What that means is there's virtually no relationship between risk sentiment and the US dollar. Markets are just not sure. It has certainly lost that negative correlation and therefore that safe haven identity. Another thing to look at is positioning, as we often do, and looking back a few months, the market was very short Kiwi US, speculators that is. This captures the Kiwi US exchange rate futures in the US, and the CFTC there publishes great weekly data on how many speculators are long or short the Kiwi US exchange rate. And it's a good proxy, I think, for the world at large. Yes, it doesn't capture all the physical flows around the world, but I think you could probably extrapolate that to some degree. So anyway, markets are very, 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 very short Kiwi US, and whenever that happens, you usually eventually do get a reversal. And you can see the reversal has already started. And the other thing you can spot is when you do get a reversal, it doesn't just go a little bit, it does go at least back towards the neutral zone, back to the zero or zero positioned mark. So I think we've got a wee way for that one to play out as well. So that's the essence of our slightly bullish Kiwi-US view. Kiwi-Aussie, second most important currency for us. We thought it'd go down, and it actually went the other way. I got that one very wrong. What was the reason for that? Really all about the Trump-related panic. So that'll be my get out of jail card. But it was indeed the reason. The Aussie dollar is moved more by global risk sentiment than is the Kiwi. And so when you had that 2nd of April panic in global markets, a lot of things just melted down, but they picked on the Aussie more than the Kiwi, and that's where you got Kiwi-Aussie rising substantially. We've had a bit of a pullback since then, and that was after Trump backtracked on the China tariffs. So that started to cause Kiwi underperforming the Aussie. But that's kind of run its course now. And then we had the news yesterday from the Reserve Bank, whereby it is not as dovish as the markets had hoped for. And that is going to cause New Zealand Aussie yield spreads to rise. So there's a picture of that one. They've already risen a bit, and this was yesterday. If I reproduce this chart, they're actually above zero now. So our interest rates are now above Aussie short-term interest rates for the first time in about 9 months. That's quite a big deal. And I think this could play out a bit further still. We had an initial reaction to the Reserve Bank yesterday afternoon, and then we came in this morning and we've had another half day of reaction as well, which is pretty sizable. So I wouldn't be surprised to see this reaction continuing to run its course over the next few weeks, pushing up that yield spread, and that's going to be a positive in the Kiwi-Aussie's favour. So why have we got it going down the other way 3 months out? That's just sticking to the view that eventually China, which has lots and lots of fiscal and monetary headroom to resuscitate its economy if need be, will become one of the shining lights. And Kelly touched on that a little bit in his global chart. So you can see China could be one of the world's beacons of economic performance, and that will rub off on the Aussie more than the Kiwi. Onto interest rates. Last time around, we said that tentatively we've hit a low in short-term swap rates, and we'll go sideways and then up, and it kind of went sideways for a while, but then we crashed down again to a new level. What was the reason for that? Mr. Trump again. So panic in the world, and everyone goes, gee, lots of economic underperformance everywhere, lots of global uncertainty and risk, so central banks will now have to cut even more than we thought they would have had to. And that's what pushed the short-term rates lower. But since then, again, you know, the panic subsided somewhat. And since yesterday, you heard Kelly tell you that the way the Reserve Bank is seeing things and how the market is now reading the Reserve Bank is actually quite different. Markets are now thinking that the Reserve Bank is very close to the end of the line in terms of easing, and there's even a possibility that you might not even get any more easing at all. So let's see how market pricing looks. And this was at the close of yesterday. That's the black line. The solid blue line is where the Reserve Bank pushed its OCR forecast down to. You can see the dotted line is where they were before. Quite a drop. Now that on its own, you would have thought, oh gee, that's pretty dovish. The market should have reacted and pushed rates lower on the back of that. What do? Yesterday they pushed them up 10 points. Today they pushed them up more than 10 points. And as I say, I think that reaction can keep going further. So what do they see that was actually hawkish? And by the way, that black line now is at about 3%, so it's actually higher. So the black line is actually moved up yesterday, it's moved up again today. Again, Kelly talked about a lot of those things that the market saw, such as the dissenting vote, somebody voting to just keep rates on hold and not cut anymore. There was also the press conference where the Governor Hawkesby basically batted off questions about, do you still have an easing bias? And he said there's no bias. So if you thought there was an inkling of an easing bias you wanted to project or communicate, you would have said so. And in times past, the previous governor would have certainly said that. The current governor basically just batted off and said there is no bias. And so the market was quite surprised at that and a few other things and thought, gee, this is actually a lot more hawkish than we expected today. So they have been spooked. So to say, yeah, that black line right now is pretty much sitting at about the same level as Kelly and team's OCR forecast. Now, Kelly and team's OCR forecast has for some time, as you know, been at the top of the market. Right here and now, I say that looks like a pretty good forecast. And what it tells you is that barring a negative surprise, if things play out as we expect, you saw from his economic forecast, then market pricing won't go any lower. And in turn, that means swap rates won't go any lower at the short end. So we've hit a bottom. So that's going to be our base case. Finally, just a word on yield curve slope. Some people are interested in this if they're thinking about hedging or locking in from floating to fixed. Right now, the yield curve in New Zealand is quite steep, mainly because we've had a big easing cycle. And globally, yield curves tend to kind of move together, generally because central banks around the world are seeing similar things and they're easing as well. So everyone's been easing, and the yield curves have been rising across countries. The very recent spike, that was the panic. So that occurred not for central bank reasons, that occurred for sentiment and panicky reasons, which caused an aversion to holding a longer-term bond or a longer-term interest rate instrument. So investors basically just jumped out of those things, and that caused the yields to spike higher for long-term rates, like 10-year rates, 20-year rates, and so forth. And we got a further spiky steepening of the yield curve that wasn't caused by anything to do with central banks. With that panic having subsided somewhat, and our own easing cycle getting close to an end, you would think that you should see yield curves starting to flatten. And that would normally be my base case, that we'll start to see a flattening from here. A few months ago, before this panic, I was actually calling yield curves to turn around and start flattening significantly. I think they'll flatten a bit, but not a lot. Why not a lot? Because this global concern about various countries' economic performances and their elevated debt levels, which could get even more elevated, are going to keep global bond yields pretty high. I think there's a lot of nervousness out there in the bond markets. So yes, we'll flatten a bit, but don't expect the yield curve to flatten to, say, flat levels whereby a short-term rate's the same as a long-term rate, and then it makes your hedging decision really, really easy. So I think we're going to have to be living with a steep-ish yield curve for quite a long time yet. Thank you very much.